As most of you know, I have fairly strong views on elements of crypto, in particular Bitcoin, which has brought me into conflict with every member of this panel at one point in the past. But fortunately, I actually consider ourselves just like good Americans, able to actually settle our disputes outside of this. And so I really, really appreciate Nick Carter joining us from Castle Rock Ventures, Lynn Alden joining us from, is it Lynn Alden is the name of your company?
Yes.
No, okay, Lynn Alden, that's what I was saying. And of course, Eric Balchunas from Bloomberg, who has written books not only on, or who is not only a proponent of crypto in ETF form, but has also written books favorable to passive investing. So we are still able to get up here and have a fantastic discussion on this. When I pose this to each of you, first of all, I can't say thank you enough for joining us. And secondly, when I pose it to you, one of the things that I brought up is this has been an incredible year for the crypto space in terms of the transition into traditional finance. And so Eric, you probably more than anyone else have highlighted the role of ETFs, the introduction of ETFs, and there's been some really fascinating developments around it, right? I mean, as I put it in the email to you, Bitcoin came in like a lion, and then there was the whimper of Ethereum. And so the question I would ask is, as you look at the crypto space from your perch in the ETF world, what's next, what's coming, et cetera?
Yeah, so James and myself, Seifert on my team, were obsessed with this. It was 11 years in the making. And so that's a long time. Even SPY, the first ETF, only sat with the SEC for 4 years. So this is like 2.5 times that. Most ETFs sit with them for 2 months, 3 months, right? It's no big deal. And so every 10 years, ETFs go into a new asset class. And it's really exciting if you're an analyst like me. And so we were obsessed. We predicted there would be some assets. And here's why. The ETF is just such a convenient, liquid, low-cost tool that everybody, it's their preferred vehicle. It's like digital music. It's like the MP3. Every other investment vehicle feels clunky compared to the ETF. And so anything you put in it has a fighting chance for investors. And we thought, well, there is definitely friction involved with getting Bitcoin and risk. Remember, this is just after FTX. And so we were like, ETFs are going to, especially you got BlackRock and Fidelity, this give a lot of advisors cover. Larry Fink says it's okay. And so you have the brand name, the low cost, and the liquidity right off the bat. These things traded quickly. Those three things, that's like checking all the boxes. So it wasn't a shocker they were such a big hit early on. Although they superseded our estimates, we predicted $10 to $15 billion in flows in the first 12 months, and the Bitcoin ETFs right now are at about $19 billion with 3.5 months to go. Ether, we predicted would be much less. Silver is only 10% of precious metal assets. Gold has like 90. We thought it would be something like that, and so far that seems to be the case. I think most normal people, they're like, I'm good with the Bitcoin, don't need anything else, thank you, and they just go on with their lives. So I think these other coins will probably struggle. I mean, they'll get a little bit, but nothing like Bitcoin. To me, that was the, sort of holy grail of the crypto space, and now it's in spot form, and it's one of the biggest, it is the fastest growing category in history.
So, Nick, you were a big proponent of it, and we've been very frustrated with the SEC in particular. As Eric pointed out, it took forever for it to make it through. How do you look at the success of getting the ETFs out, raising $19 billion, and where do you see this going from here? Does it continue to grow in Bitcoin? Does it grow in other assets? Where are you focused right now?
Yeah, so before I started my firm, I worked at Fidelity. I was on the crypto team there, and my entire job was to pitch the internal leadership team on building Bitcoin products. And they had begun doing that in 2014. Years and years later, they were able to get out the door with this Bitcoin ETF, and that was about 15 years into Bitcoin's journey. Was achieving that maturity and finally being integrated into the true infrastructure of traditional finance. And to me, that felt like we had reached a destination of sorts. Like the early days of crypto are done, and we achieved an incredible objective, which it took Grayscale suing the SEC and winning. The SEC was very intransigent, as they have been. And I think that represents a real maturation, a real vindication of the asset class. That's one thing I noticed in a lot of people's eyes. It like really legitimized Bitcoin for better or for worse, right? Some people may not like that. But I think that is, now we have options, just recently announced against the ETF, and now you can hold in your brokerage without having to pay 200 basis points to Grayscale and their horrible trust product that caused so much damage over the years. So to me, it's kind of, like pat ourselves on the back a little bit, like this is done. The Bitcoin journey is going to continue. Bitcoin itself has a lot more to do technologically, but in terms of achieving that final integration, it's almost a new phase, going from the cowboy era, the sort of wildcat era of Bitcoin, to now this period of maturity. And I think over time it'll just become a feature of all weather portfolios. There will be serious allocators. We already see it, but serious allocators that just consider Bitcoin as a part of those portfolios that incorporate all number of assets alongside gold. So I don't see the other crypto assets meaningfully penetrating there. I don't think Wall Street really understands the case for Ethereum or Solana, nor should it. I think the story is just Bitcoin's leveling off, reduced volatility, and just continued growth from here.
So Lynn, you were one of the first to kind of approach this from a true economics or finance standpoint. In particular, you were really fantastic in terms of highlighting some of the challenges that the dollar may face in the post-COVID era. You were one of the first people to bring up the analogies to the 1940s and the waves of inflation associated with that. When you look at Bitcoin, you look at it primarily as effectively a monetary asset as compared to a speculative asset. Is that a fair assessment, or do you not see it that way? Am I misunderstanding your position?
Yeah, I view it as a monetary asset. I
Okay.
think it's an emerging monetary asset, which
Okay.
means it's being explored. It's the technology's still somewhat new. The volatility is obviously high. The fact that it hasn't even the fact that it only reached ETF level recently meant that a lot of the operators were these more sketchy ones. Sometimes offshore, sometimes the trust products that don't stay near their net asset value necessarily. And so there's been these components to it that added speculative fervor to it. But I think what we're seeing is kind of the monetization of Bitcoin over time.
So what does that mean to you when you talk about the monetization of Bitcoin? What does that actual phrase mean?
I think part of it is going through that journey from kind of collectible to store of value to sometimes medium of exchange. And if something gets further enough, it could be unit of account. But it's in the earlier phase of that, which is to say that it's something that people can hold like a cash balance in, hold a long-term savings asset in. And one, they have bare asset capability, so you can actually hold it yourself if you choose to. Even though this is like an ETF panel, one of the key features, you can hold it yourself. And then two, even though it's a fairly small volume now, the fact that you have the optionality to transfer it to something else, like as a medium of exchange, gives it monetary properties in a way that, say, art doesn't have, historically speaking, unless you break it up into kind of IOUs and credit. Technically, you can trade those. Mm-hmm. So the fact that it's a bare asset, it's liquid, it's fairly fungible, gives it these monetary properties in a way that stocks and art and real estate don't really have in and of themselves. And one example I like to point out is that, when people say Bitcoin is not money, it's like, well, my book sold in currencies and Bitcoin. So far, no one's asked to buy the book in gold coins, or gold IOUs or silver pieces. And, there's a fairly small number of things that people buy things in other than fiat currencies, and Bitcoin is not one of them. I think that it's one of those things where it's not saleable to any sort of dense degree in any given country. But when you look globally, it's actually one of the more saleable monies that you could bring with you if you want to go to an urban center anywhere in the world and find a way to eventually get it off your hands. And so, for example, I like to bring up the example that I have Egyptian pounds from when I spend time in Egypt, and if I try to get them off my hands in New Jersey, especially in small amounts, it's harder than getting your hands a casino chip off of your hands. Mm-hmm. And so Bitcoin is more saleable in New Jersey than the Egyptian pound is, and 100 other fiat currencies. It just doesn't have any sort of dense monopolistic jurisdiction in a way that every fiat currency has.
Interesting. Eric, when you think about it in that context, in the idea of an ETF, does the existence of the ETF make that more likely or less likely, right? Because effectively that whole self-custodying, which has been a big issue in the Bitcoin space, people are voting and saying, nah, I'd rather have BlackRock hold it for me. I'd rather have Fidelity hold it for me.
Yeah, this was a thing early on. A lot of the crypto Twitter community, who I've gotten to know over the past year, basically. Yeah, and love-hate relationship. Yeah. It's definitely different than the advisor world I normally traverse in. But some people early on, a lot of them were like, oh my God, BlackRock filed, number go up. That's the general reaction. But there 10% of them will be like, whoa, guys, why do we want to give this over to Larry Fink? The whole point is decentralization. This is like the king of TradFi. And I get that tension. So it's like, number go up, but more TradFi. Ugh, you know? I think at the end of the day, my take on how a normal investor views this and why, I don't think they think it's a currency as much as just young gold or digital gold. You know, to me, Bitcoin is like gold as a teenager. It's volatile, it's got attitude, it's gonna steal your car. But at the end of the day, it does store value. And if you believe that the government's going to continue to print their way out of problems across the world, which is a pretty easy thing to believe because it happens, this is one way to store value. And I think that's generally how the advisor, or we'll call it the normal 60-40 world, is allocating. I also think they're trying to cure future FOMO. They've seen this thing surge a couple times, and they've kicked themselves, and they're like, look, I don't even know it, I don't even like it, but I don't want to kick myself if it goes to $1 million. So I'll put 1% in it just so I'm not mad at myself in 10 years. So I think that's the general thought process. I don't think any of them are buying it to go the distance with, oh my God, if there's some kind of a situation or collapse in society, this will be currency I can exchange with. I think they see that they like it for the security and the goldness of it. In my opinion, I mean, you guys might differ, but I generally think that's what they're doing. But unlike gold, which is 4,000 years old and doesn't move much, like if you graph Bitcoin and gold, Bitcoin makes gold look like a money market fund. But I will say in the modern portfolio, which I know we've debated on a separately many times, the core of many portfolios is very boring. Everybody got married to cheap index funds. So they're like, I'm just going to wait 30 years. But they're looking to have a little fun. So their little hot sauce bucket, I call it, on the portfolio. And so Bitcoin, to me, fits in better than gold. Because A, it's got the store of value, but it's got that risk asset surge that can get your blood flowing if there's a nice rally. So to me, this checks all the boxes in a practical manner for why people are buying it. But I do not think it's going to be a world currency is one of the reasons that most of the people in the ETF world are buying it.
So I liked the description of the excitement, spoken like a true Phillies fan. Nick, what's your reaction to what Eric said?
You know, I also noted the same concern people had about BlackRock coming in. Obviously, BlackRock is the biggest now ETF sponsor for Bitcoin. Fidelity's up there, and you have other traditional names, Van Eck, Franklin Templeton, among others. And Bitcoiners are very suspicious and sort of conspiratorial type, which we've all encountered. And the difference, I think, with you know, let's say traditional equities and Bitcoin is when BlackRock ends up owning a large share of some stock because everybody's buying it through them, they do have the ability to exercise some governance control over that company. And we see this misfiring, like I think the canonical example is ExxonMobil, where, you know, some small activist hedge fund was able to put board members on, you know, because BlackRock had this like sort of ESG agenda at the time, which maybe they don't anymore. But so because of the fact that BlackRock was, you know, amassing all of this, you know, these household savings and then acting as a single entity, you know, they were able to exercise some measure of control, possibly to the detriment of Exxon, in my opinion. That's not really possible with Bitcoin, you know, and I think that's the beauty of it, is Bitcoin's governance, to the extent there is any, is very slow-moving. It's very, very hard to push any change through, basically impossible, frankly. The last time we had to upgrade to the code, I think, was in 2021, maybe with Taproot, and the last time before that was in 2017 with Lightning. And the consensus mechanism for Bitcoin, proof of work. People don't like it, of course. It involves emissions and all of these mining machines that are all over the planet. It's functionally impossible today to gain any control over that or agglomerate them into a single entity. So I think the difference there is that Bitcoin, the protocol itself, is so resistant to change that not even Larry Fink and BlackRock can influence it. So even though they may ultimately end up controlling a large share of all the coins, I don't believe they would exert political control, which, by the way, for Ethereum is not the case.
Yeah.
So that is something to be concerned about.
Can I? Can I ask him a question?
Of course. Yeah.
One of the other things they'll bring up is they'll say, FDR confiscated the gold, and if the government were to want to confiscate BlackRock's Bitcoin, I get the idea of them. I would think BlackRock would comply. That to me, what do you think of that?
It was a very different time. We had Japanese internment camps around that time. Standards were a little more lax. The FDR was more of a dictator than a president, not to litigate history or anything like that. I don't think you would see an Order 6102 today because we don't have that level of authority vested in the president. But you're right. If there was a law passed, of course BlackRock is going to comply with that. You're right.
Yeah, one of the few kind of aspects of Bitcoin that's not really replicated in anything that came before it is that you can break ownership up across jurisdictions and entities. Like even with gold in your own possession, it's still in one place. Of course, you can split it up in different vaults, but each individual piece is in one place. With something like Bitcoin, you can break it into a multi-signature scheme where you need 3 out of 5 signatures to move it, and you could technically spread them around different jurisdictions. So there's really no single entity, even some governments, that would be able to actually physically get it back. And so there's different trust models of what people are looking for. I think at the end of the day, the idea of is Bitcoin money or is it something we put in ETF, it partially comes down to what need you're trying to solve. In Africa, there's over 40 different currencies. In Latin America, there's over 30 different currencies. Many of them are quite weak. And then even if they're holding up okay, they have all these cross-border frictions, trade frictions, getting financing in currencies. And whereas in the United States, if you poll this room and say, how many people have a payments problem on a daily basis? How many people have trouble paying? Are you dissatisfied with your payment technologies? It's not near the top of our list of concerns we have. We're not usually blocked in terms of things we pay. Whereas one of Bitcoin's first use cases was WikiLeaks getting deplatformed from payment processors and therefore turning to it. I know plenty of examples of people in all these different countries. The HRF, the Human Rights Foundation, covers this pretty well, where people turn to stable coins or Bitcoin when they find that their own country's banking rails are turned against them. But in this setting, that's not really the perspective that many people in the room have. And so we view often Bitcoin as something you hold and you just kind of look at it once in a while and it just sits there in your portfolio, whereas in a lot of other places or a lot of people that are kind of pushing the envelope forward, they're actually looking at it for more of its monetary properties.
So part of what you're referring to in that framework, right, is this underlying point of Bitcoin may not actually be relevant to Americans now, but the idea of being able to offer relief to those who are facing corrupt banking systems, et cetera, justifies the development of it. When we think about that part, let's jump off the ETF portion for a second and talk about actually Bitcoin. One of the things that I kind of notice is that since the launch of the ETF and since the halving, et cetera, many of the traditional metrics that were cited for the growth of the Bitcoin network have stagnated. I think it's a fair term, but I'm not entirely sure as somebody outside the space if I'm watching the right stuff. So what would you watch, or how do you think about those issues, Nick, and kind of where we are right now?
Yeah, that's a great question. I mean, it's like you don't have traditional financial metrics with which to evaluate Bitcoin. That you can't do a DCF on it. There's no earnings, so nobody yet, I think, has proposed a good fundamental model for what it ought to be worth. We look at things like, general adoption. I know that's hard to quantify, but one thing I look at is this great study that Chainalysis puts out every year, which is Chainalysis is an on-chain data analytics company. And every year they look on-chain at the blockchain. They find out where it's being used, what countries. And that tells you a lot about the cultural salience of Bitcoin, So the top 5 countries this year, I believe, were in order: India, Nigeria, Indonesia, Vietnam, and Argentina. I might be misremembering that. But so if you look through the places where Bitcoin it is penetrating on a per capita basis, it's not the U.S. is actually normally near the top too. But generally speaking, it's places with kind of weak property rights, a weak monetary regime, places that are maybe not fully integrated into the global financial system. A proxy for that would be the cost of remittances. And so I think that's very telling. Like a place like Nigeria, there huge amount of stablecoin adoption, lots of crypto adoption there. It's a young population. They're entrepreneurial. They want access to global finance. They want to start a business, import goods, things like that. The traditional financial system there fails these people. Of course, there's inflation in the Naira. They don't trust it. So it would be things like that I would look to see, where these pockets of adoption are happening. And I think it does underscore Lynn's point that it's maybe not that relevant to Americans, and maybe it never will be. Like, compare America to China and India in terms of the cultural salience of gold. It's not a common thing for households in America to have like all these gold trinkets and gold bullion, and like we sort of have it in America, but nowhere near the level to which it penetrates in countries like that. So it may never be the case that it's a big thing in America. But that would be the kind of stuff that I'd look at, like increasingly moving away from household adoption, even towards nation state adoption. I know the El Salvador one, people kind of make fun of them for that, but Bhutan is now mining, the kingdom of Bhutan. They have 600 megawatts of Bitcoin mining. They keep stacking Bitcoin every month. So it's stuff like that I sort of look at.
Well, they have a lot of your stranded natural gas as well, right? So
they do.
Hydro, right?
And
what's that?
Hydro in Bhutan, right?
Is it hydro in Bhutan?
They have a lot of hydro.
Yeah.
Got it. Okay. So, Lynn, from your perspective, right? I mean, you were very quick into the community and adopted a lot of the language and have written, extensively on it. Would you answer in a similar fashion to Nick in terms of how to think about measuring Bitcoin adoption? Are there metrics that you're watching that don't fall into the traditional hash rate or transactions?
I mean, I think there's different metrics to look at depending on what you're looking for. One of the ones is that there can be some confusion between Bitcoin-denominated metrics and then the dollar-denominated equivalents of those metrics, because as Bitcoin gets more valuable, if it goes up 10x in price, but then some of those metrics are
Transactions
stagnant.
could fall, for example.
Yeah, and so for example, if you look at dollar-denominated volumes, kind of say cycle to cycle, they've been on a very strong uptrend. Obviously, market capitalization and overall price has been on a structural kind of higher high, higher low uptrend. You generally see bigger spikes in fees, but then they keep returning to a pretty low baseline. There's always kind of these efficiency gains that keep happening, ways to kind of get around those high fees. I think eventually we might lift off and have a kind of a permanently higher floor in fees, but that hasn't really happened yet. I think being involved in the venture side, I mean, I think that the products are better now than they were 5 years ago. So the wallets that are out there now are better than they were 5 years ago. A lot of the places that the infrastructure, some of the Lightning infrastructure is better. There's been breakthroughs in some of the other potential scaling methods, like BitVM, for example. There's been these, as Nick mentioned, it's very hard to change Bitcoin with soft forks. It's kind of one of the, not the only differentiator, but a key differentiator compared to other cryptos.
Right, it's very fork resistant. Yeah.
It's very hard to change. And so that's kind of forced innovation for people to find, what can we do if we don't have a soft fork? And there's actually been, I'd say, a blossoming of some of those developments over the past 12 to 18 months. So I think among those metrics, I think there's a lot to be optimistic about. And it's, just kind of watching where it's going with the cycle. One of the things I've found, and I partnered with Sam Callahan, we did a research report, just kind of looking at Bitcoin's price correlation with various measures of global liquidity, and then also how other assets prices correlate with global liquidity. And Bitcoin happened to be the highest correlate with global liquidity. And so sometimes these metrics we see might have nothing to do with Bitcoin. It's just what's happening with all this money sloshing around in the system. And Bitcoin goes through its cycles of being in favor and being out of favor and being a little bit in favor. And I think we're somewhere mid-cycle, so we see a lot of kind of middling variables right now.
So maybe that's actually a good place to jump off for a second, because you brought up the venture space. Nick, you've mentioned it as well. Obviously, it's your primary focus with Castle Rock. Where is money going in the space? It's not going into mining. It's not going into, at least what I would think of as traditional exchange development. Exchange volumes are stagnating for the most part as more and more goes into TradFi on the ETF side. Where's money going in the crypto space right now?
On the venture side?
On the venture side, yeah.
Yeah. So historically, there's been nothing to actually invest in Bitcoin on the venture side.
Yeah.
I was a Bitcoiner and a venture capitalist, and I didn't have anything to do. In the
So
last,
you argued with me? Like,
yeah, I had to fill the time somehow. In the last 24 months, things have changed. Bitcoin has begun to inherit, this might be a little too esoteric for this room, but it's begun to inherit these scaling solutions that were developed for other blockchains, other more nimble blockchains. Bitcoiners have decided that it's time to embrace some of these technologies. Roll-ups would be an example. Ways to compress a lot of transactional data into a tiny amount of transactional data, whilst maintaining the same kind of settlement assurances and the trust guarantees. So having one transaction effectively represent hundreds or thousands. And so there has been a huge amount of activity there. So new layer 2 networks for Bitcoin. Lightning was previously kind of the ordained layer 2 network for Bitcoin. That one, I don't know, we might disagree on this, Lynn, but I think Lightning has stagnated a little bit as a technological focus for Bitcoin, or just didn't achieve the traction people thought it would. And so now Bitcoiners have gone elsewhere, looking at Ethereum, looking at other blockchain networks to inherit these technologies. So on the venture side, huge amount of activity there, the most I've ever seen Bitcoin. Then there's still the general financial infrastructure that people build, exchanges. Those are still getting financed, brokerages, especially in emerging markets. We're seeing a lot of activity there. As the regulatory climate's turned very hostile here in the US, we have begun shifting our focus outside the US to West Africa, certainly Latin America, a huge hotbed of crypto innovation there. Southeast Asia is probably the #1 global hotspot. So we do a lot of work in those places. And then, it's a reality in crypto that a huge amount of venture dollars go into new blockchains, not just Bitcoin, Ethereum, Solana, et cetera, but new competitors with new technological, modalities. That's actually probably where the bulk of it goes. So Bitcoin is actually, over its history, even though it's done exceptionally well, has been relatively underdeployed from a VC perspective. Most of the venture dollars have gone into competing blockchains, which is kind of funny.
Largely because they're easier to monetize, would be my understanding of that.
Yeah, I mean, you can make more DPI by investing in the next Bitcoin than in Bitcoin itself. Yeah.
And this is one of those things that people argue it both ways, because they'll say, look how little venture capital is going to Bitcoin, look how much is going into the rest of the crypto space. I mean, I forget the report, something like 70 billion over some handful of years went into crypto space, and excluding one or two companies that got the bulk of it, Bitcoin funding was in like the hundreds of millions during that time frame. It was like basically 1 to 2% of what you saw in the broader crypto space. And they'll say, look, there's no interest in Bitcoin. Whereas the other way to spin that around is basically like if you have a bunch of companies doing a ton of marketing development and they're still not catching up with the one that's barely doing anything, then what does that say? It's basically the efficiency that you're getting per dollar spent. And so I think not like a fairly large chunk of the crypto VC space, I would argue, is malinvestment, especially the ones that were really focused on those token economics, because they would focus on separating their financial outcome from building a long-term sustainable thing. So in traditional venture, you lock up capital for 5, 7, 10 years, and you're along for the ride for the fundamental success of what the founders are building. Whereas in a lot of the crypto space, you'd be able to get extra liquidity token-wise in 2-3 years or something along different lines like that. And I think a lot of that was malinvestment. Not all of it, but I think a good chunk of it was. And the BitVM technology I mentioned is fueling some of the stuff that Nick mentioned with roll-ups. I think we are starting to see a more blossoming of different things. I view a lot of that as complementary to Lightning. I think a lot of this can fit together, and it's good to have all this kind of competition to see what develops, what gets liquidity, what works. And then sometimes you have a thing where something could work, and then another thing could connect to it and make it better. So I think the Bitcoin kind of VC space is probably right-sized, right, for what we're seeing at the current time.
Eric, do you see any elements of the VC space in Bitcoin or blockchain from your perspective, or is that totally separate from effectively the financialization and the?
Yeah, that's like another planet.
Yeah.
In fact, obviously they're trying to put some private assets in ETFs now, so I'm starting to dabble in privates as close as I get to VC. So I would defer. I mean, they just said it better than I could.
Yeah, that's perfect. Okay. When I think about the next layer of TradFi, right, I would argue that one of the things we've had these discussions, right, that ultimately we operate in a very weird space in TradFi where so much of our securities work is still done on paper, right? It's effectively analog. And one of the things that's been frustrating, I think we see this even more so in things like structured products, which again are making their way into ETFs, is just the documentation and the paper load and everything that's required to create the stuff. Crypto offers solutions to that through tokenization, right? I mean, theoretically, digitally native securities offer capabilities that we haven't even begun to touch in the financial world. Are you guys seeing any progress towards that?
What's funny is when we started the exercise at Fidelity of like 2014, what can the blockchains be used for? The very first thing we identified was security settlement and tokenization. That was in 2014. It's been 10 years, and we have come an enormously short distance. And it's been tons of stops and starts. In 2015, 16, you had these kind of private blockchain ideas. I think they didn't really work. The main hindrance has actually been regulatory, frankly. I mean, the SEC and FINRA have been relatively hostile to tokenization efforts, to these ATS venues where these things could actually be exchanged. We now see that changing. Like BlackRock has this BUIDL product, which is a tokenized money market fund, effectively, which I think is almost $1 billion, or maybe collectively the tokenized money market funds are over $1 billion now. But that has been very slow, and much slower than I think a lot of folks in TradFi would think. And there has been an enormous amount of capital deployed into building that infrastructure, but there's a chicken and the egg problem. Like, we don't have the venues, so we don't have the liquidity, so people don't want to tokenize things, there's nowhere to put it. I'm still optimistic, but it's been 10 years of trying, and we're kind of nowhere on it.
And can I jump in with this tokenization thing? I was in Europe, and they put me on a panel as the ETF guy interviewing these token people, and I felt like a mutual fund guy interviewing ETF people, where they were like, "Oh, you're the past, tokens are the future." But so I've done some research on this. The tough part for tokenization, though, is I think people underrate how disruptive ETFs are. It is going to be very difficult to disrupt the ETF. Think about it. You want access to almost anything under the investment sun. You just click a button and you own it. And it probably costs very little. Now they package trades for you, structured products, the S&P 500, China A-share stocks, whatever. Now, what goes on behind the scenes, maybe that's archaic, the blockchain could be used for that, I get that. But does that make the system more fragile? Because you've got an administrator, you've got a custodian, all these different entities with humans that you can call. So I do think that there's something to be said for that. How disruptible is the ETF when you have no friction, no cost, and a total layer of regulatory infrastructure that makes it's anti-fragile. So as an advisor with real clients, to me, I like that. I like knowing, I guess, like the best of both worlds. So we've been very bullish, especially against direct indexing. That was supposed to be the next big thing. Oh. And we're like, we were right there. Now, tokenization, I admit I'm still wrapping my head around it, but that's one of the underrated points is what does it fix for the end client that the ETF already serves up?
I think a big gap that exists right now is global versus domestic. So in the United States, we have the biggest, deepest capital markets. Our biggest concern, as you mentioned, is efficiency, paperwork, things like that. Mm-hmm. In a lot of global contexts, it's literally a matter of can they access it or not. So to use the stablecoin as an example, you basically compress the overhead of an offshore bank account into a token, so that instead of just wealthy families being able to access it, middle-class families in Argentina can now save in dollars easier than they could physically. An anecdote I like to use is that I know a physician in Egypt, works six days a week in a hospital. Then he goes to the black market, buys dollars, and stores them in his apartment as one of his key savings, liquid savings technologies in 2024.
Right.
And it's not trivial for him to access the S&P 500. It's not, he's basically got real estate, which is a liquid. He's got dollars and gold that he can access with frictions.
And hold physically, right.
Yeah, and if he wants to access, capital markets, there's been a series of blockades against that. And so to the extent that you can tokenize a dollar form, to the extent that you can go a step further, maybe tokenize a T-bill form, so maybe he gets the marginal yield on that dollar. To the extent you want to tokenize the S&P 500 or other major global assets that might be of interest to him. And then you kind of replicate that for 100 plus other countries out there and people like him.
So what prevents entrepreneurs from doing that internationally? Right. I mean, theoretically, I could buy a share of Apple, tokenize it, and sell it in Egypt.
We're seeing some. I mean, there's regular. I mean, Nick goes more into this than I do, but there's regulatory issues, but we are seeing more of it over time. We are seeing stable coins pass on yield more. I don't know if you want to talk more about that.
I mean, the SEC would eventually come for you if you did that, basically.
Interesting. Okay.
It might take them a while. I mean, Lynn's point is well taken, though. The only tokenized asset that has been successful is the offshore dollar, the euro dollar, basically. Like Tether is 120 billion in supply. Stablecoins overall are 165 billion. Everything else that has been tokenized, every other tokenized security, if you add it all up, that's only 10 billion. So really what people want is dollars that are accessible on your mobile phone in a non-custodial ways, and you truly have the claim to that dollar liability. Of course, it's still the liability of an issuer, so there is an intermediary to worry about. It's not a liability-free asset like a Bitcoin, for instance, so there's a nuance there. But that is the success story of tokenization. I don't know if that's one that people talk about. It's just dollars.
Yeah, no, I'd actually love to hear your thoughts on that and expand on that a little bit.
Yeah, I mean, I think stablecoins are interesting because they challenge a lot of these narratives around crypto. A lot of Bitcoiners used to say, well, Bitcoin is going to destroy the dollar. It's bad for the dollar. Really, it's the opposite. Crypto is good for the dollar, in my opinion. If you look at all of the value settled on blockchains, 50% of it, as of right now, is in dollar terms, settling stable coins. It's not Bitcoin or Ethereum or anything else transactions, it's stable coins. So the main thing that circulates on blockchains today is dollars. And if you look at the user metrics, there's around 25 million addresses every month that are making a stablecoin transaction, tokenized dollar. And the settlement value every year of the stablecoin sector is around $5 trillion, is the latest estimates. So to me, that's a big success story. I think it shows that as crypto's usage grows, and by the way, 99% of stablecoins reference the dollar. So it's not the renminbi or the yuan or the yen or the euro, it's the dollar. 99%. Think of any other global financial network that's that dollarized. There isn't one. So in my view, it's good for U.S. interests. These stablecoins are buying U.S. debt instruments. I think that's a net positive flow into the debt, which Lord knows we need buyers, the debt right now. And it reverses this narrative of crypto being bad, hostile to U.S. interests, bad for the dollar. To me, very unambiguously positive for it.
So I share actually some of those views. I think it's been very interesting to watch as effectively it's turned into something more like the euro dollar than anything that is designed to compete with the US dollar. Where do we stand on the transparency? The Tether audit was done a couple of years ago, I assume. No.
We're still waiting for that.
Still waiting for that. What's the holdup?
I think Tether has the best business on the planet. They
certainly at 5% interest rates, they do.
Yeah,
they're holding anywhere close to what they say they're holding.
They make $6.5 billion a year. They have 30 employees. The leadership just hangs out in Italy and the Caymans. They just issue tokenized dollars. Can or Fitzgerald claims that they have the dollars, so it depends if you trust Howard Lutnick or not. But yeah, there's no audit. They don't feel like they need to do that.
Yeah.
Other stablecoins would like to, grow and penetrate, and there are U.S. issued ones. There's some very credibly issued ones, like Paxos, New York trust license company, like bankruptcy remote, very solid back-end infrastructure. It's just that people tend to want Tether. Tether is 70% of the stablecoin market. So for whatever reason, the shadiest operator is also the biggest operator.
Lynn?
Well, it's an international issuer, and it's predominantly a product that is used by international people. We can kind of like break stablecoins into two main use cases. One is DeFi, so various kind of smaller institutions coming in and using it as leverage, using it as the source of liquidity and trading and things like that. That's a lot of that happens on Ethereum, for example. And then there's the medium of exchange and like intermediate term savings usage, the international, the thing that might eat into that doctor, instead of buying dollars, might buy stable coins. That's more on Tether on Tron. And that's how that market's kind of segmented.
Do you see a risk to the idea of Bitcoin as a store of value, or any of the tokens as a store of value, as more interest gets paid and basically Tether turns into a true euro-dollar type framework where it's almost more like a money market fund?
Well, one is Tether actually takes some of their profits and buys Bitcoin, because they have now, like they report that they have an asset amount that exceeds their liabilities. And so for some of their surplus assets, they actually stack Bitcoin with it. I think in the kind of the intermediate term, it can pressure the Bitcoin in the sense that if you're in, say, Nigeria and you want something more stable in your currency, you have some credible choices between, say, Bitcoin and stable coins, depending on what your use case is. I think it's not really any sort of competition against a long-term holding, because if you're holding dollars without yield, even dollars with yield, because usually the yields are not sufficient, but dollars without yield or only part of the yield, you are getting diluted as part of the overall network, compared to owning gold or Bitcoin or anything that's fairly scarce. So I don't really view it as like that long-term challenge, but there are substantial amounts of global cash balances that, especially when they're, looking to hold value for 6 months or 12 months or 2 years, and they have to trade off between Bitcoin scarcity but volatility and the dollar's, gradual dilution but stability. And so that's the market that they really kind of compete over.
So when I think about the dynamics of a euro dollar, for example, though, I'm buying a dollar at a discount in the future, right, through the interest rate mechanism. Is there something on the horizon like that for stablecoins?
I wouldn't say so. I think it's, the main innovation that's happening in stablecoins now is that people are embedding native interest provision into them. So just simply by holding some units of a stablecoin in your wallet, you're earning roughly 500 bips automatically.
But so there's not a forwards or a futures market that you see developing off of that framework?
We haven't seen that yet.
Interesting. That's actually really interesting. Okay, we need to wrap it up. I have been asked not to do questions from the audience because I just discovered that we can't hear those if we're streaming. Anything you'd like to close with, Nick? Anything that you're particularly passionate about right now?
I think stablecoins are where all the action are right now. I think Bitcoin has, as I said, kind of reached maturity to a certain extent, and a lot of the work there is done. The most interesting thing to me in crypto right now is the penetration of stablecoins into global payments networks, and I think that will really surprise people over the next decade.
Okay. Lynn?
I'm bullish on Bitcoin and stablecoins. That's been where I think a lot of the actual use cases is for people around the world. Bitcoin for the long term, and stablecoins for when you need lower volatility and when you want access to dollars, which is still the predominant unit of account globally.
Got it. Eric, anything you're seeing out there?
We're waiting for the options on the Bitcoin ETFs and the Ether ETFs. Options bring a lot of the institutions in, and the traders. And then there's other coins. There's been a filing for XRP and Solana. We're calling that, the Fed put, the Trump call. Those are filings that, just in case he wins, who knows, Gensler's out, maybe Hester Peirce is the commissioner, and anything's possible. So the election is the next big variable in this sort of Bitcoin or crypto ETF world.
Okay, and so somewhat famously, I have a bet with Peter McCormick in Bitcoin. He offered me 5-to-1 odds that he would pay me $100,000 if Bitcoin did not hit $100,000 this year, and I have to pay him $20,000 if it does. Should I double up on the bet? Should I let him get out at a discount? What's the trading advice?
If Trump wins, it could hit 6 figures.
Okay.
on election night.
Bitcoin can do a lot in 1 quarter. It wouldn't be my base case, but it can always surprise to the upside.
It seems like every time it hits 69,000, which is so apropos,
69.
it goes right back down. So I would say you're going to win because that's 69. That's not like 99. It just seems to be like stuck at where it gets around the all-time high. It just
I'm
seems
a little
to have a bunch of
tempted
sellers.
because I can buy 95,000 call options for December 30th for like $1,100 right now. So maybe that's the route I should go then. Okay, thank you very much, guys. Great way to end it up. I hope you stay for the wine.